How to get started investing in mutual funds. Investing is one of the most important things you can do to secure your financial future. However, it can be a daunting task, especially for those who are just starting out. The world of finance is complex, and it's easy to get overwhelmed by the jargon and technicalities. This is where mutual funds come in. Mutual funds are an excellent way for beginners to start investing. They offer a simple and convenient way to invest in a diversified portfolio of stocks, bonds, and other assets, without requiring a large amount of capital or extensive financial knowledge. This book is an excellent guide for those who want to get started with investing in mutual funds. It is written in a clear, concise, and accessible manner, making it easy for anyone to understand the basics of mutual fund investing. From the history of mutual funds to the different types of funds available, this book covers everything you need to know. The author does an excellent job of demystifying the investment process, explaining key concepts such as risk and diversification, and providing practical tips for selecting the right mutual funds to suit your investment goals and risk tolerance. This book is not just for beginners, however. Even experienced investors will find it a valuable resource, with insights into advanced investment strategies and techniques. I highly recommend this book to anyone who wants to get started with investing in mutual funds. It's a great resource for those who are looking to secure their financial future and build wealth over the long term. Chapter 1: Introduction to Mutual Funds. Investing in mutual funds is an excellent way to start building wealth and securing your financial future. But before we dive into the specifics of mutual fund investing, let's start by defining what mutual funds are and how they work. What are mutual funds? A mutual fund is a type of investment vehicle that pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other assets. The portfolio is managed by professional fund managers who make investment decisions on behalf of the investors. When you invest in a mutual fund, you own a share of the portfolio. The value of your share is based on the net asset value of the fund, which is calculated by dividing the total value of the portfolio by the number of shares outstanding. The NAV of a mutual fund fluctuates with changes in the value of the underlying assets. Types of mutual funds. There are many different types of mutual funds, each with its own investment objective and risk profile. Here are some of the most common types of mutual funds. 1. Equity funds. These funds invest primarily in stocks and are suitable for investors who are looking for long-term capital appreciation. 2. Fixed income funds. These funds invest primarily in bonds and other fixed-income securities and are suitable for investors who are looking for a steady stream of income. 3. Balanced funds. These funds invest in a mix of stocks and bonds and are suitable for investors who want a balanced approach to investing. 4. Index funds. These funds track a specific stock market index, such as the S&P 500, and are suitable for investors who want to match the performance of the index. 5. Specialty funds. These funds invest in specific sectors or industries, such as technology or healthcare, and are suitable for investors who have a strong understanding of the sector or industry. Benefits of investing in mutual funds. Investing in mutual funds offers several benefits over other types of investments, including 1. Diversification. By investing in a mutual fund, you can gain exposure to a diversified portfolio of assets, which can help reduce the risk of losses due to the performance of any one particular asset. 2. Professional management. The portfolio of a mutual fund is managed by professional fund managers who have the expertise and experience to make informed investment decisions. 3. Convenience. Mutual funds are easy to buy and sell, and you can invest in them with as little as a few $100s. 4. Affordability. Because mutual funds pool money from multiple investors, the cost of investing is spread out, making it more affordable for individual investors. Mutual funds are an excellent way for beginners to start investing in the stock market. They offer a simple and convenient way to gain exposure to a diversified portfolio of assets, with the guidance of professional fund managers. In the following chapters, we'll dive deeper into the specifics of mutual fund investing, including how to select the right funds for your investment goals and risk tolerance, and how to monitor the performance of your portfolio. Chapter 2: Understanding Risk and Return in Mutual Funds. When investing in mutual funds, it's important to understand the relationship between risk and return. All investments involve some degree of risk, and mutual funds are no exception. However, the level of risk you're willing to take on can have a significant impact on the potential returns you can expect to earn. Risk in mutual fund investing. Risk refers to the possibility of losing some or all of your investment. In mutual fund investing, there are several types of risk to consider. 1. Market risk, the risk that the overall stock market or bond market will decline, affecting the value of your mutual fund. 2. Credit risk, the risk that the issuer of a bond held in the mutual fund will default on its payments. 3. Inflation risk, the risk that the value of your investment will be eroded over time due to inflation. 4. Interest rate risk, the risk that changes in interest rates will affect the value of your bond holdings. 5. Currency risk, the risk that changes in currency exchange rates will affect the value of your international investments. Return refers to the profit or loss you can expect to earn from your investment. In mutual fund investing, returns are typically measured in terms of annualized percentage returns. The potential returns you can expect to earn from a mutual fund will depend on several factors, including the investment objective of the fund, the performance of the underlying assets, and the fees and expenses associated with the fund. The relationship between risk and return in mutual fund investing is generally positive. This means that the higher the level of risk you're willing to take on, the higher the potential returns you can expect to earn. However, it's important to remember that higher returns also come with higher risk, and there's no guarantee that you'll actually earn those returns. While it's not possible to eliminate risk entirely, there are several strategies you can use to manage risk in mutual fund investing. 1. Diversification. By investing in a diversified portfolio of assets, you can reduce the risk of losses due to the performance of any one particular asset. 2. Asset allocation. By allocating your investments across different asset classes, such as stocks, bonds, and cash, you can balance your risk and return. 3. Monitoring. By regularly monitoring the performance of your mutual fund holdings, you can identify any potential red flags and make informed investment decisions. 4. Rebalancing. By periodically rebalancing your portfolio to maintain your desired asset allocation, you can manage risk and ensure that your investments align with your investment goals and risk tolerance. Understanding the relationship between risk and return in mutual fund investing is essential for making informed investment decisions. By understanding the types of risk in mutual fund investing, as well as the potential returns you can expect to earn, you can develop a well-informed investment strategy that aligns with your investment goals and risk tolerance. In the next chapter, we'll explore how to select the right mutual funds to suit your investment needs. Chapter 3: Choosing the right mutual funds for your investment needs. Once you have a basic understanding of mutual fund investing and the types of risks and returns involved, the next step is to select the right mutual funds to suit your investment needs. Choosing the right mutual funds involves a combination of factors, including your investment goals, risk tolerance, and investment horizon. 1. Identify your investment goals. The first step in choosing the right mutual funds is to identify your investment goals. Ask yourself questions such as, what am I investing for? When will I need the money? How much risk am I willing to take on? For example, if you're investing for retirement and you have a long investment horizon, you may be willing to take on more risk in exchange for potentially higher returns. On the other hand, if you're saving for a short-term goal, such as a down payment on a house, you may prefer a lower risk, more conservative investment strategy. 2. Assess your risk tolerance. Once you've identified your investment goals, the next step is to assess your risk tolerance. Your risk tolerance refers to your ability and willingness to take on investment risk. This can depend on a variety of factors, such as your age, financial situation, and investment experience. It's important to choose mutual funds that align with your risk tolerance. If you're a conservative investor with a low risk tolerance, you may prefer funds that invest primarily in fixed income securities, such as bonds. If you're a more aggressive investor with a high risk tolerance, you may prefer funds that invest primarily in stocks. 3. Consider the fund's investment objective. Each mutual fund has a specific investment objective, which can vary widely depending on the fund. Some mutual funds focus on specific asset classes, such as large-cap stocks or high-yield bonds. Others may focus on specific investment strategies, such as growth or value investing. When selecting mutual funds, it's important to consider the fund's investment objective and whether it aligns with your investment goals and risk tolerance. For example, if you're investing for income and you have a low risk tolerance, you may prefer a bond fund that focuses on high-quality fixed-income securities. On the other hand, if you're investing for growth and you have a higher risk tolerance, you may prefer a growth-oriented stock fund. 4. Evaluate the fund's performance. One of the key factors to consider when selecting mutual funds is the fund's historical performance. While past performance is not a guarantee of future results, it can provide valuable insight into the fund's investment strategy and management. When evaluating a mutual fund's performance, it's important to look at both short-term and long-term performance. Short-term performance can be influenced by market fluctuations and may not be a reliable indicator of the fund's long-term potential. Long-term performance can provide a better indication of the fund's consistency and potential for achieving its investment objectives. 5. Consider the fund's fees and expenses. Mutual funds charge fees and expenses, which can vary widely depending on the fund. These fees and expenses can impact your investment returns, so it's important to consider them when selecting mutual funds. Some common fees and expenses associated with mutual funds include management fees, the fees charged by the fund's investment manager for managing the fund's assets. Expense ratio, the total annual expenses of the fund, expressed as a percentage of its assets under management. Sales load, the commission paid to the fund's salesperson or broker when you purchase the fund. When selecting mutual funds, it's important to consider the fees and expenses associated with each fund and how they may impact your investment returns over the long term. Choosing the right mutual funds is a critical step in building a successful investment portfolio. It requires careful consideration of your investment goals, risk tolerance, and investment horizon, as well as an understanding of the fund's investment objective, performance history, and associated fees and expenses. By taking the time to research and evaluate different mutual funds, you can make informed investment decisions that align with your financial objectives and investment strategy. Remember, investing in mutual funds involves risks, and it's important to consult with a financial advisor or do your own research to ensure that you understand the risks and potential rewards of your investments. In the next chapter, we will discuss how to purchase mutual funds and build a diversified portfolio that meets your investment needs. Chapter 4: Purchasing Mutual Funds and Building a Diversified Portfolio. Now that you have a better understanding of mutual fund investing and how to choose the right mutual funds for your investment needs, the next step is to purchase the funds and build a diversified portfolio. 1. Open an investment account. To purchase mutual funds, you will need to open an investment account with a brokerage firm or mutual fund company. There are many options available, from traditional full-service brokerage firms to online discount brokers. When choosing a brokerage firm, consider factors such as fees and commissions, investment research and resources, and customer support. You may also want to consider the types of mutual funds available through the brokerage, as well as any minimum investment requirements. 2. Determine your asset allocation before purchasing mutual funds. It's important to determine your asset allocation. Asset allocation refers to the mix of different types of investments, such as stocks, bonds, and cash, in your portfolio. Your asset allocation will depend on a variety of factors, including your investment goals, risk tolerance, and investment horizon. For example, if you have a long investment horizon and a higher risk tolerance, you may choose to allocate more of your portfolio to stocks. On the other hand, if you have a shorter investment horizon and a lower risk tolerance, you may prefer a more conservative allocation with a greater emphasis on fixed income investments. 3. Choose your mutual funds. Once you have determined your asset allocation, you can begin selecting the mutual funds that will make up your portfolio. When selecting mutual funds, it's important to consider factors such as the fund's investment objective, performance history, fees and expenses, and diversification. To build a diversified portfolio, consider selecting mutual funds that invest in different asset classes and sectors. This can help spread your investment risk and reduce the impact of market fluctuations on your portfolio. 4. Monitor your portfolio. Once you have built your mutual fund portfolio, it's important to monitor it on a regular basis. This can include monitoring the performance of the individual funds, rebalancing your portfolio to maintain your desired asset allocation, and making adjustments as needed to align with your investment goals and risk tolerance. Remember that investing involves risks, and there is no guarantee that your investments will perform as expected. It's important to consult with a financial advisor or do your own research to ensure that you understand the risks and potential rewards of your investments. Purchasing mutual funds and building a diversified portfolio can be a great way to achieve your investment goals and build long-term wealth. By opening an investment account, determining your asset allocation, choosing the right mutual funds, and monitoring your portfolio, you can create a successful investment strategy that aligns with your financial objectives and risk tolerance. In the next chapter, we will discuss some common mistakes to avoid when investing in mutual funds, as well as some tips for achieving long-term success with your investments. Chapter 5. Common mistakes to avoid when investing in mutual funds. While mutual funds can be a great investment option, there are also common mistakes that investors make when purchasing and managing their mutual fund portfolios. Avoiding these mistakes can help you achieve long-term success with your investments. 1. Chasing performance. One of the most common mistakes investors make is chasing past performance. While past performance can be an important indicator of a fund's potential future performance, it's not a guarantee of success. It's important to look beyond a fund's past performance and consider factors such as the fund's investment objective, fees and expenses, and management team. By focusing on these factors, you can make more informed investment decisions and avoid the trap of chasing performance. 2. Overlooking fees and expenses. Fees and expenses can have a significant impact on your mutual fund returns. It's important to review a fund's fees and expenses before investing to ensure that they are reasonable and in line with industry standards. Some common fees and expenses to look for include management fees, 12b-1 fees, and other operating expenses. Be sure to compare the fees and expenses of different funds to ensure that you are getting the best value for your investment. 3. Failing to diversify. Diversification is key to reducing investment risk and achieving long-term success with your mutual fund portfolio. Failing to diversify can leave you vulnerable to market fluctuations and other risks. When building your mutual fund portfolio, be sure to diversify across different asset classes and sectors. This can help spread your investment risk and reduce the impact of market fluctuations on your portfolio. 4. Ignoring your investment goals and risk tolerance. Investing in mutual funds requires careful consideration of your investment goals and risk tolerance. Ignoring these factors can lead to investments that are not aligned with your financial objectives or risk tolerance. Before investing in mutual funds, take the time to assess your investment goals and risk tolerance. This can help you select the right funds and build a portfolio that aligns with your investment strategy. 5. Failing to monitor your portfolio. Finally, it's important to monitor your mutual fund portfolio on a regular basis. Failing to monitor your portfolio can leave you vulnerable to market fluctuations and other risks. Be sure to monitor the performance of your individual funds, rebalance your portfolio as needed to maintain your desired asset allocation, and make adjustments as needed to align with your investment goals and risk tolerance. By avoiding common mistakes and focusing on the fundamentals of mutual fund investing, you can achieve long-term success with your investments. By focusing on factors such as a fund's investment objective, fees and expenses, and management team, as well as diversifying your portfolio and monitoring your investments on a regular basis, you can build a successful mutual fund portfolio that aligns with your financial objectives and risk tolerance. Chapter 6. Evaluating mutual fund performance. When investing in mutual funds, evaluating performance is essential to ensure that your investments are meeting your expectations and helping you achieve your financial goals. Here are some key factors to consider when evaluating mutual fund performance. 1. Total return. The total return of a mutual fund is the combination of its capital appreciation and any income it has generated, such as dividends and interest. When evaluating a mutual fund's performance, it's important to consider its total return over the short and long term. 2. Benchmark comparison. Comparing a mutual fund's performance to a relevant benchmark is an important part of evaluating its performance. A benchmark is a standard index or measure of performance that the mutual fund is trying to achieve or exceed. For example, if you are invested in a large-cap equity fund, you may want to compare its performance to the S&P 500 index, which is a common benchmark for large-cap U.S. stocks. 3. Risk-adjusted return. While total return and benchmark comparison are important factors to consider, they don't tell the whole story. It's also important to evaluate a mutual fund's risk-adjusted return, which takes into account the level of risk the fund has taken to achieve its returns. One common measure of risk-adjusted return is the Sharpe ratio, which takes into account a fund's returns and the level of risk it has taken to achieve those returns. The higher the Sharpe ratio, the better the fund's risk-adjusted performance. 4. Expense ratio. The expense ratio is the amount of money a mutual fund charges for managing the fund, expressed as a percentage of the fund's assets. It's important to consider a fund's expense ratio when evaluating its performance, as higher fees can eat into your returns over time. 5. Morningstar rating. Morningstar is a popular independent investment research firm that assigns a rating to mutual funds based on their past performance and other factors. Morningstar's rating system ranges from 1 to 5 stars, with 5 being the highest rating. While Morningstar's ratings should not be the sole factor in your investment decision, they can be a useful tool when evaluating mutual fund performance. Evaluating mutual fund performance is an essential part of managing your investments. By considering factors such as total return, benchmark comparison, risk-adjusted return, expense ratio, and Morningstar rating, you can make informed decisions and ensure that your investments are aligned with your financial objectives and risk tolerance. Chapter 7. Large-cap mutual funds. Large-cap mutual funds are a type of mutual fund that invests in large companies with a market capitalization of over $10 billion. Large-cap companies are often well-established and have a long history of stable earnings and dividends, making them an attractive investment option for many investors. Here's what you need to know about investing in large-cap mutual funds. Advantages of investing in large-cap mutual funds. 1. Stability. One of the primary advantages of investing in large-cap mutual funds is the stability that they offer. Large-cap companies are often well-established and have a long history of stable earnings and dividends, which can help to provide a stable source of income for investors. 2. Lower risk. Large cap companies are often less volatile than smaller companies, making large cap mutual funds a relatively lower risk investment option. While there is always some level of risk involved with any investment, large cap mutual funds can offer a more stable and predictable return over time. 3. Diversification. Investing in large cap mutual funds can provide investors with exposure to a wide range of large cap companies across various industries, helping to diversify their portfolio and reduce the overall risk of their investments. 4. Liquidity. Large cap mutual funds are often more liquid than other types of mutual funds, making it easier for investors to buy and sell shares as needed. Disadvantages of investing in large cap mutual funds. 1. Limited growth potential. While large cap companies are often well established and have a long history of stable earnings and dividends, they may not offer the same growth potential as smaller, more volatile companies. As a result, large cap mutual funds may not provide the same level of return as other types of mutual funds. 2. Limited exposure. While investing in large cap mutual funds can provide diversification across various large cap companies, it may not provide exposure to other types of companies or assets that could offer higher returns. 3. Higher expenses. Large cap mutual funds may have higher expense ratios than other types of mutual funds, due to the higher fees associated with managing a larger portfolio of stocks. Choosing the right large cap mutual fund. When choosing a large cap mutual fund, it's important to consider factors such as the fund's track record, expense ratio, management team, and investment strategy. It's also important to consider your own investment goals, risk tolerance, and time horizon when selecting a large cap mutual fund. Large cap mutual funds can be a stable and relatively low risk investment option for many investors, offering exposure to well-established companies with a long history of stable earnings and dividends. However, it's important to carefully consider the advantages and disadvantages of investing in large-cap mutual funds, and to choose the right fund that aligns with your investment goals and risk tolerance. Chapter 8: Mid-Cap Mutual Funds. Mid-cap mutual funds are a type of mutual fund that invests in companies with a market capitalization between $2 billion and $10 billion. Mid-cap companies are often smaller and less established than large-cap companies, but they may offer higher growth potential than large-cap companies. Here's what you need to know about investing in mid-cap mutual funds. Advantages of investing in mid-cap mutual funds. 1. Growth potential. One of the primary advantages of investing in mid-cap mutual funds is the growth potential that they offer. Mid-cap companies are often in the early stages of growth and expansion, which can lead to higher earnings and higher stock prices. 2. Diversification. Investing in mid-cap mutual funds can provide investors with exposure to a wide range of mid-cap companies across various industries, helping to diversify their portfolio and reduce the overall risk of their investments. 3. Lower valuations. Mid-cap companies are often less well-known and less established than large-cap companies, which can lead to lower valuations and more attractive prices for investors. 4. Potential for active management. Since mid-cap companies are less well-known and less established than large-cap companies, there may be more opportunities for active managers to identify undervalued companies and outperform the market. Disadvantages of investing in mid-cap mutual funds. 1. Higher risk. Mid-cap companies are often more volatile and less established than large-cap companies, making mid-cap mutual funds a relatively higher risk investment option. While there is always some level of risk involved with any investment, mid-cap mutual funds can offer a more volatile and less predictable return over time. 2. Limited liquidity. Mid-cap mutual funds may be less liquid than large-cap mutual funds, making it more difficult for investors to buy and sell shares as needed. 3. Limited track record. Since mid-cap companies are often in the early stages of growth and expansion, They may not have a long history of stable earnings and dividends, which can make it more difficult to evaluate their performance and potential. Choosing the right mid-cap mutual fund. When choosing a mid-cap mutual fund, it's important to consider factors such as the fund's track record, expense ratio, management team, and investment strategy. It's also important to consider your own investment goals, risk tolerance, and time horizon when selecting a mid-cap mutual fund. Mid-cap mutual funds can offer higher growth potential than large-cap mutual funds, but they also come with higher risk and less predictability. It's important to carefully consider the advantages and disadvantages of investing in mid-cap mutual funds, and to choose the right fund that aligns with your investment goals and risk tolerance. Chapter 9: Small Cap Mutual Funds. Small cap mutual funds are a type of mutual fund that invests in companies with a market capitalization between $300 million and $2 billion. These companies are often the smallest and least established companies in the market. Investing in small-cap mutual funds can offer investors a high growth potential and the opportunity to invest in companies that may become future leaders in their respective industries. Here's what you need to know about investing in small-cap mutual funds. Advantages of investing in small-cap mutual funds. 1. High growth potential. Small-cap companies are often in the early stages of growth and expansion, which can lead to higher earnings and stock prices. Investing in small-cap mutual funds can provide investors with exposure to these high-growth companies and the potential for significant returns. 2. Diversification. Small-cap mutual funds can provide investors with exposure to a wide range of small-cap companies across various industries, helping to diversify their portfolio and reduce the overall risk of their investments. 3. Potential for active management. Small-cap companies are often less well-known and less followed by Wall Street analysts, which can lead to more opportunities for active managers to identify undervalued companies and outperform the market. 4. Low valuations. Small-cap companies are often overlooked by Wall Street and may trade at lower valuations than large and mid-cap companies, which can provide investors with more attractive prices and potential for growth. Disadvantages of investing in small-cap mutual funds. 1. High-risk. Small-cap companies are often less established and more volatile than larger companies, making small-cap mutual funds a relatively high-risk investment option. While there is always some level of risk involved with any investment, small-cap mutual funds can offer a more volatile and less predictable return over time. 2. Limited liquidity. Small-cap mutual funds may be less liquid than large or mid-cap mutual funds, making it more difficult for investors to buy and sell shares as needed. 3. Limited track record. Since small-cap companies are often in the early stages of growth and expansion, they may not have a long history of stable earnings and dividends, which can make it more difficult to evaluate their performance and potential. Choosing the right small-cap mutual fund. When choosing a small-cap mutual fund, it's important to consider factors such as the fund's track record, expense ratio, management team, and investment strategy. It's also important to consider your own investment goals, risk tolerance, and time horizon when selecting a small-cap mutual fund. Small-cap mutual funds can offer high growth potential and the opportunity to invest in companies that may become future leaders in their respective industries, but they also come with higher risk and less predictability. It's important to carefully consider the advantages and disadvantages of investing in small-cap mutual funds, and to choose the right fund that aligns with your investment goals and risk tolerance. Chapter 10: International Mutual Funds. International mutual funds are a type of mutual fund that invests in companies based outside of the investor's home country. These funds can offer exposure to companies and industries that may not be available in the domestic market, and can provide investors with diversification and potential for higher returns. Here's what you need to know about investing in international mutual funds. Advantages of investing in international mutual funds. 1. Diversification. Investing in international mutual funds can help investors to diversify their portfolio and reduce the overall risk of their investments. International mutual funds offer exposure to companies and industries that may not be available in the domestic market, helping to spread the risk of your investments across a wider range of assets. 2. Growth potential. International mutual funds can offer access to high-growth markets and industries that may not be available in the domestic market. Investing in international mutual funds can provide investors with exposure to companies that are leaders in their respective industries, and the potential for higher returns. 3. Currency diversification. Investing in international mutual funds can also provide investors with exposure to different currencies, which can help to diversify their portfolio and reduce the risk of currency fluctuations. 4. Hedging against inflation. International mutual funds can provide a hedge against inflation, as they are often invested in companies that are less affected by domestic economic conditions. Disadvantages of investing in international mutual funds. 1. Currency risk. While investing in international mutual funds can provide currency diversification, it also exposes investors to currency risk. Changes in currency values can affect the return on an investment in an international mutual fund. 2. Political risk. Investing in international mutual funds can also expose investors to political risk, such as changes in government policies or instability in foreign markets. 3. Higher fees. Investing in international mutual funds can be more expensive than investing in domestic mutual funds due to the costs associated with currency conversion and international transactions. Choosing the right international mutual fund. When choosing an international mutual fund, it's important to consider factors such as the fund's track record, expense ratio, management team, and investment strategy. It's also important to consider the political and economic stability of the countries in which the fund is invested, as well as the currency risk associated with the investment. International mutual funds can offer exposure to companies and industries that may not be available in the domestic market, and can provide investors with diversification and potential for higher returns. However, they also come with risks such as currency risk and political risk, and can be more expensive to invest in than domestic mutual funds. When choosing an international mutual fund, it's important to carefully consider the advantages and disadvantages, and to choose a fund that aligns with your investment goals and risk tolerance. Chapter 11: Sector Mutual Funds. Sector mutual funds are mutual funds that invest in a specific sector or industry, such as technology, healthcare, or energy. These funds offer exposure to companies that are leaders in their respective industries and can provide investors with the potential for higher returns. However, they also come with risks associated with investing in a single sector. Here's what you need to know about investing in sector mutual funds. Advantages of investing in sector mutual funds. 1. Focus on a specific industry. Sector mutual funds allow investors to focus on a specific industry, which can provide them with exposure to companies that are leaders in that industry. This can offer investors the potential for higher returns than investing in a broad-based mutual fund. 2. Diversification within a sector. Investing in a sector mutual fund can also provide diversification within a sector. These funds often invest in a range of companies within a sector, which can help to spread the risk of your investments across a wider range of assets. 3. Potential for higher returns. Investing in a sector mutual fund can provide investors with exposure to companies that are leaders in their respective industries, which can offer the potential for higher returns than investing in a broad-based mutual fund. Disadvantages of investing in sector mutual funds. 1. Concentrated risk. Investing in a sector mutual fund can expose investors to concentrated risk, as these funds are often invested in a specific industry or sector. Any negative developments or events in that sector could negatively affect the returns of the fund. 2. Limited diversification. While investing in a sector mutual fund can provide diversification within a sector, it does not offer diversification across different sectors. This can increase the risk of your investments and limit your exposure to other potentially profitable industries. 3. Higher expense ratios. Sector mutual funds can be more expensive to invest in than broad-based mutual funds due to the costs associated with specialized research and management of the fund. Choosing the right sector mutual fund. When choosing a sector mutual fund, it's important to consider factors such as the fund's track record, expense ratio, management team, and investment strategy. It's also important to carefully evaluate the risks associated with investing in a specific sector and to consider the potential impact of industry-specific events on the performance of the fund. Sector mutual funds offer exposure to companies that are leaders in a specific industry and can provide investors with diversification within that industry and the potential for higher returns. However, they also come with risks associated with investing in a single sector, including concentrated risk and limited diversification. When choosing a sector mutual fund, it's important to carefully consider the advantages and disadvantages, and to choose a fund that aligns with your investment goals and risk tolerance. Chapter 12. Advanced Investment Strategies Using Mutual Funds. If you're an experienced investor looking to take your mutual fund investments to the next level, there are several advanced strategies you can use to maximize your returns and minimize your risk. Here are some key strategies to consider. 1. Asset allocation strategies. One of the most important decisions you can make as an investor is how to allocate your portfolio across different asset classes, such as stocks, bonds, and cash. By using mutual funds that invest in different asset classes, you can build a diversified portfolio that can help you weather market volatility and achieve your long-term financial goals. 2. Tactical asset allocation. Tactical asset allocation involves making adjustments to your portfolio based on changing market conditions or economic trends. By using mutual funds that specialize in different sectors or regions, you can make strategic changes to your portfolio to capitalize on market opportunities and protect your assets during downturns. 3. International investing. Investing in international markets can help diversify your portfolio and provide exposure to different regions and sectors. You can use mutual funds that specialize in international stocks or bonds, or invest in global funds that provide exposure to a mix of international and domestic securities. 4. Sector investing. Investing in specific sectors or industries can provide targeted exposure to companies that are likely to benefit from specific economic trends or market conditions. You can use mutual funds that specialize in sectors like technology, healthcare, or energy, or invest in index funds that track specific sectors or industries. 5. Alternative investments. Mutual funds can also provide exposure to alternative investments, such as real estate, commodities, or private equity. These funds can be used to diversify your portfolio and potentially generate higher returns, although they can also be riskier and more volatile than traditional investments. Before using any advanced investment strategies, it's important to do your research and understand the risks and potential rewards of each strategy. You should also consult with a financial advisor or investment professional to ensure that these strategies are appropriate for your investment goals and risk tolerance. With careful planning and strategic investing, mutual funds can be a powerful tool for achieving your long-term financial goals. Chapter 13. Choosing a financial advisor. If you're considering investing in mutual funds but aren't sure where to start, working with a financial advisor or investment professional can be a smart move. A good financial advisor can help you evaluate your investment goals, select the right mutual funds, and monitor your portfolio over time. But how do you choose the right advisor for your needs? Here are some key factors to consider. 1. Qualifications and experience. Look for an advisor who has the appropriate qualifications and experience for your needs. Some key certifications to look for include the Certified Financial Planner, Chartered Financial Analyst, and Chartered Financial Consultant. You can also ask about the advisor's experience working with clients who have similar needs and goals to yours. 2. Services offered. Make sure the advisor offers the types of services you need, whether that's help with mutual fund selection, retirement planning, tax planning, or other financial services. You should also ask about the advisor's approach to investment management and how they monitor and rebalance client portfolios over time. 3. Compensation structure. Understand how the advisor is compensated for their services. Some advisors are fee-only, meaning they are paid a percentage of your assets under management, or a flat fee for their services. Other advisors are commission-based, meaning they earn a commission on the products they sell to clients. You should also ask about any other fees or charges associated with the advisor's services. 4. Communication and accessibility. Look for an advisor who communicates regularly and clearly with clients, and who is accessible when you have questions or concerns. You should also ask about the advisor's approach to client meetings and whether they offer in-person or virtual meetings. 5. Reputation and reviews. Do your research and look for reviews or testimonials from other clients who have worked with the advisor. You can also check the advisor's disciplinary record on FINRA's BrokerCheck website to ensure there are no red flags. Ultimately, the most important factor in choosing a financial advisor is finding someone you trust and feel comfortable working with. Take the time to interview several advisors and ask plenty of questions before making a decision. By choosing the right advisor, you can get the guidance and support you need to achieve your long-term financial goals. Chapter 14. Conclusion. Congratulations! You have now completed the guide to investing in mutual funds. By reading this guide, you have gained a better understanding of the benefits and risks associated with mutual fund investing, as well as the different types of mutual funds that are available to you. Investing in mutual funds can be a great way to build a diversified portfolio and achieve your financial goals. By choosing the right mutual funds and regularly contributing to your investments, you can take advantage of the potential for long-term growth while minimizing your risk. Remember, investing is a long-term strategy, and it's important to stay committed to your investment plan and avoid making hasty decisions based on short-term market fluctuations. By investing in mutual funds and regularly reviewing your portfolio, you can stay on track and achieve your financial goals. Thank you for reading this guide, and we wish you the best of luck in your mutual fund investing journey. This book that was authored by OpenAI's ChatGPT. With the company taking on billions of dollars in investments, this is the perfect time to find out ways for this innovative tool to help you learn how to start investing in mutual funds. Audio for this book was provided by NaturalSoft Limited's Natural Reader AI software using their commercial license. Per their website, this license allows you to use its software and voices for commercial or public use. This includes, but is not limited to, YouTube videos, public announcements, broadcasts, and e-learning.